In terms of YY growth, it's perhaps one of the best in the last 15 quarters.
The bank has launched QIP to raise up to rupees 3,000 crore.
The Sensex is down about 400 points, so not a great start for the market.
It's a tug of war between relatively stronger fundamentals in India versus what's happening globally.
As of now, we don't see much of a challenge.
We could look at 20-25% growth year on year the next 5 years.
In the red, but I think there is some attempt to try and recover from the low.
Fact versus fake is a crucial thing, not just for the regulator, it's crucial for the investor.
Council-nominated fitment committee has declined the proposal to reduce the compensation cess.
We have not seen 4.85% on the 10-year benchmark bond since July of 2007.
The Midcap Index has come in for a big profit taking. It's down 800 points.
That was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. I've got Nigel D'Souza and Prashant with me here. It's clearly a big down day for our markets. So global markets around the world have been hit on the back of rising yields in the United States, the dollar index surging. The Nifty and the Sensex are down close to about 0.7%, but at the session lows, the Nifty was down close to about 200 points. Right now, we're down 130 points. So in the last 30 minutes, there has been a bit of a recovery that's taken place in the Nifty. So hovering around 19,400. The day's low was 19,333. But the broader markets are getting hit and getting hit hard. The Midcap Index is down 1.5%. The advanced decline ratio has about 2,250 stocks currently in the red. Hi, Nigel.
Well, hi, Reema. In fact, the Nifty Bank is the one that's the problem area, and that's the one that plays out expiry today. So we need to see some bit of recovery out there to have a more sustainable bounce from here. On a closing basis, I made this point earlier as well, that the Nifty would like to get to around 19,450. Getting into this final hour, you'll say that's a far cry, but never say never. The Nifty Bank could play a role. Well, how should you position yourself in the final hour of trade? Kush Bora joins us to help us out with exactly that. Hi, Kush. Good afternoon. Well, those who are bearish will be feeling quite good. But what do you do from here? Do you think that the bears will cover out their positions? And would you look to buy into this dip?
Hi, Nigel. First up, thank you for having me, on the show. Well, you're right. And, one thing that is standing out very clearly for me is that, we're back to that 19,550, 19,250 zones, that we spent a considerable time in somewhere around August, early September. So that would be the litmus test. As long as 19,250 holds, we should perhaps be in good stead. And, given the, result season around the corner, we could perhaps bounce from there. But if that does not hold, then, I'm afraid we could perhaps see, a lower levels as well. Will I buy the dip? Well, not on the indices, but stock specific. A lot of stocks are starting to look, a lot cheaper. A lot of froth has sort of, come off. So stock specific, I would for sure have, a lot of stocks on my radar. Indices, I would still wait and watch, see if the bank, if the Nifty holds, 19,250 and the bank Nifty holds 43,500, which was the low it made somewhere in the month of August. So yeah, on the indices, wait and watch. Stock specific action, yes, I would.
Okay, thank you very much for that. Well, the talk of town has been the US yields and the sharp moves that we've seen here. Prashant is now at the big wall and he's collated some interesting data. Prashant?
Well, thanks very much for that. So we're not going to talk about stocks and, what's happening to indices, etc., but we're going to talk about US bonds, right? Bonds have been selling off. Yields have been rising in a relentless kind of way. That is essentially the global risk-free rate, which is moving up. So risk in the system is rising, and many are talking about how even higher levels perhaps are coming. This is what the US 10-year yield has done in the last 3 months now. It's up 130 basis points. That is a very sharp move for the 10-year in a very, very short time span. We can get into the details in terms of how this 130 breaks up. A majority of this 130 is rise in real yields, and that's essentially problematic for emerging market assets, etc. But that's for another time. The question that we are asking is, after such a massive move in the last 3 months, are we sort of due for a bit of a breather? Now, I was reading a fair bit of global commentary, and there was some stuff which indicated that yes, that there is, whenever we've seen sharp rallies in US yields in a very short time span, subsequently, there is, actually a fair degree of give back. Almost a third of the rally is actually given back in the following months. So what I did is I went back all the way, this is all data from Bloomberg, went back all the way to September 2003. So this is data from 2003 all the way to now. And what we've done is, for the purpose of this, we've only taken 100 plus basis points in terms of rallies, approximately 100 plus, within 3 months, 2 or 3 months. So that's the criteria. The idea is to get, a move the magnitude of which we've seen right now, 130 basis points in 3 months. So we've kind of looked at both the time period and the magnitude of the move in a similar kind of fashion. So here's the data then. In September 2003, actually into September 2003, we got 140 basis points rally in the US 10-year. That happened within 3 months. Subsequent sell-off, which was a little longer than 3 months, I mean, that happened over a period of about 4.5, 5 months, was about 70 basis points. Almost half of it was given back. June 2004, we saw a 100 basis point rally. I mean, the rallies are all in the 2 to 3 months, mostly the 3-month period. We saw a 100 basis point rally into June 2004. From the highs there, we saw 80 basis point give back in the subsequent couple of months. June 2009 next, we saw a 120 basis point move, and you basically gave back almost 60 basis points in the next few months. February 2011, we saw a very sharp 114 basis point sort of move in the yields, and there was a almost near 80 basis point give back that we actually saw. It is 3 other instances. August 2013. This is, of course, also, if you remember, the period of the so-called taper tantrum here in India when rupee hit those levels and there was basically mayhem. The US 10-year at that point had rallied 117 basis points. This one, of course, I mean, the subsequent sell-off is not as large, but there was a 30 basis point give back that we saw. Mind you, in many of these instances, after the give back happens, yields have continued to rally. In some of the instances, not all, but what we are concerned with is a breather. And more often than not, as you see, the next one is June 2022. This is fairly recently. We saw a big, massive 150 basis point move, and almost 60 basis points was retraced after that. And this is the largest of the lot, which happened, last fall, October of 2022. We saw a near 160 basis point move in 3 months flat, and there was a 74 basis point give back that we actually did see. So, we are at that point, I would say, right? You look at these numbers and you look at the 130 basis point move that we've had since, the lows that we saw in June to where we are, which is, closer to 4.81% or so. And I think this does come in handy. History does suggest that we are due for a bit of a breather, a meaningful breather. Of course, we need to wait and watch if it actually happens or not. We've got Mark Matthews joining us from Bank Julius Baer. I think we also have Manish Singh, CIO at Crossbridge Capital LLP. Gentlemen, good to have both of you here. Thank you very much for your time. Just a quick word on the data itself. These are just 7 instances, but Manish, what's your sense? How are you looking at it? And do you think a breather is due?
Sorry, I got cut off a bit. Are you talking about U.S. Treasury yield here, right?
Yes, I was. And I was. Go on. Yes.
Yeah. So, one thing we can all conclude that, what's happening in Treasury market is unusual but not surprising. Because if you look at the BIS report and Bank of International Settlement, they have been pointing about the consternation in the Treasury market. They are highlighting the amount of shorts on Treasury, at least on the 2-year maturity. But everything that's happening on the long end is clearly being driven by higher for longer narrative. And now I am not in the higher to longer narrative. I have said this before as well. I think disinflation will be the problem very soon. And I was not surprised when you saw I don't remember who, but I think State Street came out and said that there'll be 200 basis point cuts next year. So on the long end, clearly, it is being driven by this expectation higher for longer, and TLT is suffering. But on short end, it is my opinion from what I've heard and read is that you have a lot of trades being filed on the short end. So I will not be surprised if we have a 2020-like scenario where you could have a volatile move in the opposite direction. And I hope it will be managed well, but that's the fear. If you look at the Treasury market, the way it's behaving, it is behaving like equities in many ways, as you have seen the level of vol. So it should not be surprising given the market structure keeps changing all the time, but that's what I'm looking at. However, if you are a medium-term investor, you don't have to be concerned about. But if you're leveraged and short-term, then you should be concerned about that.
Mark Matthews of Julius Baer is also with us on the show. Mark, thank you very much for joining in. The historic run on the US 10-year yields continues for yet another day. Where from here, according to you?
Our own view is that the 10-year Treasury yield will be 4.5% a year from now, which is obviously below where it is now. So we're not in the camp that we're going up to, 7%, the kind of thing that Jamie Dimon says. But I've been wondering why the yield keeps rising and contradicting what the consensus had thought would be a peak sometime back about 4.3%. And I'm starting to think it has less to do with inflation and more to do with politics. And we now have a continuation bill in Congress that will last until the 17th of November. After that, they need to pass another bill. And if the Democrats do intend to spend a lot, which does seem to be their intention, this may be the market's way of sending a message to them that it doesn't like that. The higher the government debt, the higher interest rates go because there's more supply of treasuries. And the more interest rates go higher, the creditworthiness of the country goes down. And ironically, that kind of creates a self-fulfilling prophecy. So in the absence of what I can see of any clear signals of a second wave of inflation, in fact, I think inflation is more benign. I think it's possibly something to do with fiscal spending that has the Treasury yields going up.
Gentlemen, hi, good afternoon. A lot of our viewers look at the equity market very closely and they're trying to decipher what this absolutely phenomenal rise in yields, what that means for equities. And Mark, if I could start with you on this. Now, the US market is off just 7-8% from the peak. Given this very sharp run that we've had, do you think equities have adequately priced in risks of potential accidents? And do you see any accidents on the horizon? There's some chatter building up about the US commercial real estate market, for instance. What do you think?
Well, of course, back in March, we had an episode with Silicon Valley Bank and a few other banks. And then the story was about these regional banks being faced with very problematic commercial real estate market, as you say. The problem with these things is not so much seeing them, they're always out there, you can identify them, but knowing when it's going to become an issue. Subprime mortgages were a case in point. I mean, people kind of saw the problem back in 2005, 2006, 2007. The accident didn't happen until 2008. But anyway, you were asking about the equity market. It's totally normal to have a drawdown of around 7 or 8%. The average intra-year drawdown for the S&P since 1980 has been 14%. I actually think we're putting in a bottoming process for the S&P now, and I think that we're going to get a nice fourth quarter. I know that kind of contradicts what I was talking about earlier with the Treasury yield, but I do think that the earnings in the third quarter will be good, excluding energy. They should be up about 3.5 to 5% year on year. That'll be the first positive year-on-year growth for S&P earnings in 3 quarters. And then going forward, I actually do think that the government will get the message about not spending too much, and we won't have a crazy budget, and that will take some of the pressure off of yields.
Okay, so you're not too worried about the US equity market. You're saying maybe it's in the process of making some sort of a bottom. Manish, what about you? Do you see any further risks ahead because of this 4.8% figure that we're seeing on the ticker right now on the yield?
There's always risk ahead. I won't say one doesn't see risk ahead, but you have to look in terms of level. And I do agree that, until now, the focus was on inflation. And now we have stopped talking about inflation because core PCE, if you look at the core PCE number, 1 month, 3 month average is at 2%, which is exactly where Fed wants it to be. And this is not about inflation. I agree that it's more about the fiscal policy and everything that the U.S. government is doing. And if you see the break-even inflation, because on long end, when the yields are going up, we should focus on what's happening to the break-even inflation. The break-even inflation is not moving. So the market sees this. This is not an inflation problem. This is a policy problem. And which policy, as you know, you saw the speaker is out of office last night. So there will be resolution. And if you take that into account, then equity markets are going to go higher. And let's not forget, September is always a seasonally weak month. So the fact that we've had 4% or 4.5% move down is not surprising. That's very much average to what we have seen in September. And October, mind you, first week of October has always been most volatile. 7 of the 10 biggest drawdown or sell-off has happened in October, and we still have a few days to go in the first week. Not to scare anyone, but October then finishes positive. So my personal view, as I always say, I'm more a medium-term guy. I look at medium-term. From medium-term point of view, I'm not worried at all. I think that U.S. is fine. It's the politics which is making things volatile. But if you're taking approach of medium-term, then you should be a buyer. And again, seasonality tells you that Q4 is the best quarter in the year, and the third year of the U.S. presidential cycle is the best year. So you have a lot of seasonality telling you should be buying the dip. And if you're a medium-term buyer, then you continue to buy and just build up a position.
Would you would you agree with that, Mark? Briefly, especially, yes. I mean, you've been a big bull on India, and a lot of our viewers are focused on what's happening here. This is, of course, collateral damage in that sense. But would you be a buyer of the dip?
I would. I do. I think we will get a good fourth quarter rally, and one issue is the dollar for emerging markets. But notwithstanding that, yeah, I concur with everything that Manish said. Okay. Well, I think we'll wrap up on that positive, sort of, soothing words.
But remember, Manish is saying that you have to get through the first week of October. And he says we still have a couple of days to go till we get round that corner.
We'll get through. All right, Mark and Manish, thank you very much for joining us. Great speaking with both of you here. And by the way, as we were in conversation with both of them, the markets picked up quite a bit, I think. So we are down 113 points, which means, yeah, I mean, there is from the lows of about I think 19,340. We've come up, and we were at about 19,340 at about 130 or so. We've come up to about 19,413. Even actually compared to 230, we've, I think, added about 35 points or so. So, yeah, there is a definite pickup which seems to be coming through. We'll take a quick commercial break here. Pashupati Advani of Global Foray will be joining us on the other side. Stay tuned.
Welcome back. You're with us on Closing Bell, and let's introduce our next guest on the show. Pashupati Advani of Global Foray is with us. Pashupati, hi, good afternoon. Always great having you on. So, we were just speaking to two experts to figure out if we should be really scared and worried with this rise in US yields or not. Those two gentlemen said they'll buy the dip. Now, what about you? Looking at stocks here in India, we've not had much of a dip, to be honest. But what would you do in this patch of consolidation? I think you're on mute, Pashupati.
Yeah, sorry. Yeah. Now, one of the things we have to do is actually wait for the reaction of the US, because if there's a big dive in US versus a gentle dive in US, and so far it looks like it's going to be gentle, then there's no cause to worry, and I guess one should buy on dips. But if there's a deep dive in the US, then there'll be a jump from everyone to seize opportunities. I do see some nervousness in US in commercial real estate because people are actually walking out of leases and defaulting, which is another challenge. So this is all going to pull money back to the US, and it's coming from every market in the world, including ours. So, that's what it is. Surabhi?
So you think this is going to be a deeper drawdown here in India? I mean, we're off, what, just about 600 points from the top, from 20,000. Would you be preparing for a deeper fall?
No. What I'm saying is that if the US has a deep fall, if we're basically going to follow them. If there's a gentle fall in the US, then there's an opportunity here to buy on dips because we'll go down a little bit and it'll be nice. If there's a big fall in the US, then I think there'll be a big fall here. But I think the money will go first to the US and then come back here. So then there'll be a bit of a disconnect for a period of time. So I honestly feel there aren't going to be any, what you call jhatkas, but I do feel that the market is under pressure globally, equity markets, simply because the yields are so attractive, and it's just, today it's just a lot easier to keep money in the bank. You're getting, 7+ on FDs. So why would you even, get excited, be perturbed while you wait?
Hi, Mr. Advani. Good morning. Good afternoon, Nigel on this side. I hope you're feeling much better, as we speak. Well, as you said, Mr. Advani, the markets are a little bit, in a bit of a tizzy, but sometimes that provides good buying opportunities. You have given us a couple of stocks in the past. J. Kumar, I remember, was a stock that we spoke about. Paytm was another one. In this last, couple of months or so, what have you been buying?
No, actually, I've actually been, Nigel, sitting on my hands because I honestly feel that this is a period of consolidation, and the market is feeling heavy, according to me. I mean, it has got a nice, what I call a G20 run where it reached 20,000. Now it's back at 19.5, below 19.5. The challenge is some big stocks are, have come off a lot worse, and particularly the larger banks, the IT stocks are also off, So I'm just saying that, there is concern. These are these big stocks that have finally decided to come down a little bit. So I am concerned. But on the other hand, I see that our government wants to do some infrastructure. It wants to demonstrate. So therefore, there is some bullishness in steel, cement, because the projects are still coming. They're driving it. They're leading from the front, which is great. So, there are obviously opportunities in those, but I think the opportunities are in the heavier, hard stocks rather than in the soft, even the new wave stocks. Because I just think that today you want engineering, you want hard engineering, you want hard numbers, you want hard materials, and that's where the returns are going to be.
All right. Yeah, Mr. Advani, you briefly mentioned, I think, tech as well, besides, the hard economy or the old economy stocks as well. What's your view on tech? That surprised everyone, right? There's so many headwinds. You have rising yields. You're not going to be bracing for a great earnings that are coming up. But these stocks, they continue to do well. Even in today's session, if you have to, point out what's leading a bit of a recovery, it's the IT index. So how do you position yourself out there?
See, the reality is that the dollar looks like it's getting weaker, and that obviously is good for IT. But they are not able to, according to me, perform in terms of changing their business model to be able to take full benefit. And the real headwinds are the AI, the ChatGPT, all the things that are replacing what we've been doing in the AI space in India. So those companies which are large, who have big presence outside India, are managing to tread water, but the ones who are not are obviously hurting a lot more. So, the big 4, 5 are fine. The next lot are in a different, they're not able to benefit. They're not able to benefit at all.
I know you're cautious on the markets, but what about HDFC Bank? Is that a safe stock to invest in? It's gone through a long period of consolidation, price correction, underperformance. Is it time to look at HDFC Bank?
See, HDFC Bank has been a bellwether in every portfolio for a long, long time and has performed very well until the merger. I personally felt that when the merger took place, it became too much of the index and it had to be pared down. And that material, if you want to call it in the old stock market parlance, is, according to me, still in the market. It's an overhang in the market. As a bank, it's a performer, it's a leader. But I think that, they even had a press conference about a week ago, where they actually said they're not going to be able to grow as much. They're basically trying to mind expectations towards the lower side. So the price has effectively looks like it's coming down. And I think, you move from 1650 to 1525. And, I think personally, it'll probably go down. I have a position. I have, a hedged position against it because I'm not so comfortable holding it, but I've had stock for forever. And, but it should be very much part of everyone's portfolio because it is the largest stock in the index, right? Almost second largest or second largest in the index.
Pashupati, I wonder whether you've owned the Mazgaon docks and the RVNLs of the world. There's been one phenomenal move, right? So no, don't have them?
Missed that one. The only one I kind of looked at and then sort of shut my eyes and went up by 20% of that SVJN, which did their offering. I haven't seen it since they did the offering, but they were... They're a hydro player, so they're definitely it's just money straight from. It's like oil; it's coming money straight from the hydro into the bottom line. So it's actually great.
Yeah.
It's off a little bit from the IPO, but I think that it's definitely one that should be looked at because we are looking at green energy. Hydro is the cleanest form of energy. Once it's created, it's there forever. So all the hydro players have done extremely well, and this one will also continue to perform, as long as all the money isn't sucked out of it.
Okay, so that's SGVN. Since we're on the theme, I mean, broadly, what do you think about the way we've seen this absolutely intense PSU rally play out? And they're not correcting too much, these stocks, though they've gone up 100, 200, 300%. And RVNL is down some 10, 11% from the top. That's it. So you have the railway plays, the defense plays, even power. I mean, Coal India. The other day, Nigel and I were staring in disbelief. I think it was towards the end of September. Coal India was suddenly up 20% in 1 week. So if you were to continue to hold on to PSUs or buy any fresh PSUs, apart from SJVN, any other themes?
See, the thing is that the government also needs to realize some cash by selling off some of the juicier PSUs. And they're trying to sell away the good companies where there's still some kind of, they sell 5%, 10% into the market. Then they can do secondaries. They can sell LIC probably has a position in them along with the President of India, so they can also continue to sell. So that provides liquidity. So I think that's what they're trying to do. They're trying to get the public into believing that the government is doing well for these companies and is giving them business. Now, obviously, you've got this railway line coming from Mumbai to Ahmedabad. Those companies that are going to benefit, most of them are PSUs. So they should be bought. And, you may not see the return immediately, but definitely once the line gets going in, one cycle, it'll be fabulous. But till that happens, you just have to sit on it, and you probably won't even see much dividend in the interim because you're continuing to spend the money on growth. So, but definitely these are stocks that should be looked at because they've been undervalued for so long. There is some value in them.
Okay, all right, Mr. Advani, what about pharma? Do you believe all the bad news is in the price? Now, I'll plot, say, a 5.5 year chart on the index itself. There's virtually no movement. Individual stocks, they've come back, though. What's your view at current reckoning on pharma?
They're starting to consolidate, and they've all been through that bad period where they failed FDA inspections. They've got their act together. They've cleaned it. So they're actually looking at a consolidation phase and an upward phase. There is some issue on some of the generic drugs getting caps on them. So that's what's kind of putting a sort of lid on them. But the reality is, and then of course, you've got someone like Cipla, where the promoters basically put the company up for sale. So that's going to be interesting once that happens, if somebody comes through. But honestly, our pharma industry is one of the strongest in the world. It's here to stay. We have a population that anyone can tell you 230 million diabetics, everyone's on high blood pressure, everyone's on cholesterol. So that industry is here to stay. And, even if you don't have to export, the domestic industry is just so huge and it's getting bigger and bigger. So it has to be there. Yes, it hasn't been a great performance. It's been lackluster, but that's basically because of price caps. But I think that will change.
Pashupati, thank you very much for joining in. Need to slip into a very short break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our technical experts.
Welcome back. Well, we've come off close around 70 points from the low point of the day. So there is a bit of a bounce that we're seeing. I just want to pull up two segments of the market that are doing well. One is the IT space. That's seen a big bounce from the low point of the day and continues with its resilient ways. And the other one, which could be a sector by itself, is Reliance Industries. So the intraday chart of both those two come up for you, and that explains why the Nifty has seen a bit of a recovery from the day's low. Massive recovery. Just take a look at that. Perfect. That's the chart that we're looking at. How do you trade from here, though? And what are the calls that Kush Borar brings to us? He's joining us. Kush, well, surprise, surprise, a good recovery is what we've seen. But you got a couple of trading calls?
Well, I mean, as long as we end off lows, it's going to be a pleasant surprise for all of us, isn't it? So, yeah, and as I said a while back, I have a lot of stocks on my radar from, buying the dip perspective. One of them, which has not really dipped per se, is Escorts Kubota. The stocks actually just perhaps, paired some of its gains that it made, a couple of days back, and still very well holding on to its 20-day moving average. So Escorts is one stock that I have on my radar. 3,300, 3,375 are the near-term targets that I'm looking at. 3,150 is where I would place my stop loss. One stock that I would actually, look very keenly at buying on dips is Canara Bank. The entire PSU story still seems to have a lot of steam. It's just that it's gone in the pause mode, and once the Bank Nifty expiry is over today, these stocks could perhaps gain some traction again. So Canara Bank, from a near-term perspective, 385, 399 are my targets, and 360 is where I would place my stop loss.
Okay, all right. Canara Bank and Escorts, those are the two stocks that Kush is looking at. Well, the recovery continues. We're now down only around 90 points odd. The problem is the Nifty Bank is not recovering. And if that can recover, then maybe we'll cross that 19,450 mark on a closing basis. But it's a good time to get a sneak peek into D-Street chatter. Nimesh joins us to tell us what is he picking up. Nimesh, well, a weak day, but otherwise we're seeing some bit of a bounce from the day's low.
The good part is there has been a recovery, and as you rightly explained, IT is helping the bulls, Reliance is helping the bulls, but the bigger drag is coming from the financial names. And I'll put a word on the financials largely because the index is on 1%, and across the board, whether it's NBFC, whether it's private banks, they are under pressure. In fact, in some private banks, there is buying as well. I'll add into my chatter as well. But despite that, there are sharp cuts, 4 to 5%, 7% as well. So financial has been a big drag for the markets in today's trade. I guess the fact that despite such weak global cues, we are pulling back and we are showing resilience. That's actually to me a positive sign. But there are first signs of some bit of cracks in the broader markets as well. The index is on 1.5%. Unlike yesterday, when the markets were down, the broader markets were in the green. Today there is selling pressure and some bit of nervousness as well across the board in the broader market. So looks like there are first signs of some bit of nervousness in the mid-cap and small-cap space. Apart from IT and Reliance, the other sector which has been a bit of a defensive is the consumer staples. Throughout the day, there is a sense that some bit of buying is back in the consumer staple name. So to me, looks like from here on, the consumer staples will be defensive. Pharma to some extent will be defensive. And if there is a bit of a recovery in the Nasdaq, even IT would play to it. So these are the sectors to hide is the overall feedback. But the bigger worry is the first signs of crack in the broader markets and the fact that the financials are still a drag with a lot of cuts in the private bank stocks as well today.
Nimish, today after a while, actually, I heard about some HNI's lightning positions. It's been after quite a few days, actually. So let's see how that goes. Maybe it could be a one-off day, but after a while, I've heard, that from various desks that there is some lightning of select positions, particularly in the broader markets, as you said. Okay. What about individual stocks? What are you picking up?
So in terms of individual names, there are a lot of interesting names. The first stock on my list today is Som Distilleries. In a weak market, that stock is up in trade and on good volumes as well. I understand the company is likely to raise funds via QIP very soon. It can get launched in a day or two. And the company is likely to raise close to 250 crores via QIP. So that's the first one. The second stock is Valchanagar Industries. Again, the stock is in ESM stage 2, so it's a 2% circuit stock. It's locked at 2% upper circuit in today's trade. There was a notice today for a board meeting scheduled on 6th of this month. And I understand some marquee names are going to invest in terms of HNIs. We're going to invest in a preferential issue, and hence that stock is buzzing in trade today. The third stock is Axis Bank. I spoke about while the overall banking sector is under pressure, Axis Bank is down 4%, but there are strong delivery-based buying in Axis Bank for the last few days. I understand a long-only fund has done active buy. Even in today's trade, there were good bids in Axis Bank at an FID. So that's the third one. And the last stock is Aurobindo Pharma. For second day running, that stock is under pressure. Some bit of profit booking looks like, and a long-only FI seems to be an active seller in Aurobindo Pharma for the last 2 days. So even in today's trade, the delivery volumes are going to be quite high on the downside on this particular name.
Okay, thanks very much. Interesting list there. Nimesh, as always. Aurobindo, of course, has done very well. It's basically doubled this year. Now Nimish is saying that there is some selling pressure which is coming through. Well, 90 points lower is what we have, 19,437 at this point. We have Prakash Diwan now joining in. There is, I think, still I think 11 odd minutes, 20 minutes to go for market closing. Prakash, we had the management of SBI. The SBI chairman was on board in the morning. And this is with regards to the story on, housing interest subvention scheme for urban. 60,000 crores allocated to it, spread over a period of 5 years. Of course, the cabinet is yet to sign off on it, but seems like the government is keen. In that space, in that housing finance space, the SBI MD also gave us some numbers in terms of, this may lead to new 50 to 60 lakh new loans, which could be made over time period, which is almost 50% of what was done earlier. So it's very meaningful. But do you like anything in the space, housing finance space?
Good afternoon, Prashant. So I think the headwinds that we are seeing crystallizing are extremely positive for that space. There's no reason why given the kind of demographics that we stare at, housing can't be one of the growth areas. It's a great employment generator, remember, which is what the government would also want to look at. It also kind of monetizes a lot of the assets that most of these players have. So real estate has been kind of sanitizing itself through so many regulatory changes. And it's probably time for that to be backed up with funding all of that growth through housing loans. And my personal view is that you have a lot of good companies that have kind of managed to stay away from a lot of the weaker sections of housing finance, the segments that have been generally prone to a lot of NPAs and all. And whatever most of the companies who have the strong balance sheets would probably grow. So to answer your question specifically, within housing finance companies, I don't see any better bet than PNB Housing Finance. Last Diwali, we discussed this on Awaz, one of our sister channels, that this is a space where this is a company which is transforming itself, given the new ownership, the change in management, the fresh, thought process on the strategy that's come in, and look how it's performed. I mean, from 400 whereabouts is probably, almost 80% up. And this still has enough legs to grow. So, whether it's a Canfin Home, whether it's a PNB Housing Finance, some of the more affordable housing finance companies which are catering to those segments also look very promising, Prashant. And then, of course, you have cement and home improvement as other sectors that you could look at, if not just pure housing finance space. But and don't forget the fact that today with HDFC and HDFC Bank combined, which housing remains a core focus, and the kind of upsell opportunities they will start leveraging once this becomes a reality. In fact, a major share of all this incremental gains will go to some of these well-established names before it percolates down to the smaller players. So there's enough levers that are kind of emerging once HDFC Bank is out of the woods from a technical liquidity standpoint. There's this liquidity overhang which will need to get absorbed in the market. But once that happens, the growth metrics will start looking very favorable.
Okay, all right. Hi, Prakash. Good afternoon, Prakash. What about Delta Corp? These tax notices coming in there, it's clearly spoiled sentiment, and the stock is at around 135 odd. What's your view on it? I mean, how much of the bad news is in the price? This is a stock that just maybe around, in the last 12 months or so would have been almost double its price.
So, good afternoon, Nigel. So, let me tell you from the ground up with the information that I have, within the Goan, locations that they are present, there has been a huge change in the way everything is administered. Because this, by the way, this 28% levy got implemented from the 1st of October, and 1st and 2nd happened to be holidays. So it was only second night post 12 o'clock that things started normalizing for them. And the number of transactions they can do in terms of, when you go in to buy chips and get finally people to get on the floor is much more lesser than what they used to do in their peak times. So it's also going to impact the way people are going to respond to, the consumer is going to respond to. So I think till that data starts improving and you have empirical evidence that this hike in taxation has been digested by the players, I don't think there's going to be any respite. So, I mean, people will only, and there will be a lot of investors who will be wanting to get out at probably superior levels than where it is today, because a lot of them have not got exits except for some big exits which happened in the beginning of this downfall. So my sense is they'll probably struggle at every rise. But till the data turns positive, there's nothing that you can think of very positively out of this.
Tax troubles for Puravankara looks like. The stock is down 2.5%. IT department is conducting raids at Puravankara. 40 premises are currently being searched. That's what we've picked up from ANI. The stock has taken a bit of a nosedive. Prakash, what about Jubilant FoodWorks? Now, in the last 1 year, Jubilant FoodWorks stock price is down 15%. Versus the Midcap Index, which is up 28%. We know the demand has been tough. The consumer preference has shifted towards burgers. But, is that now adequately priced in, given the underperformance? And now the company is making efforts to try and boost up sales. They've announced today that they've cut down prices by 40% for the veg and non-veg pizza. So that's quite a significant price correction.
No, absolutely, Rima. I think what the management is trying to do is reset their business model to cater to a very wider segment of audience and target group, instead of being very focused on to people who are just kind of used to consuming pizzas. I mean, the whole business model is now competing, and we spoke about this when the likes of Swiggy and Zomato came into the picture. Jubilant was not competing with other pizza players like Pizza Hut and all, but it was competing with the biryani and the burger players as well. So, the competitive intensity took some time for them to come to this conclusion, and probably now strategically they're realigning themselves. But I think there is value in that, given their sheer footprint, given the kind of processes and systems that they have in place. I don't see any reason why there will be any let up in single sales. Store sales growth, because that SSS number is something which everybody is very keen to look at, and that is something which will happen because they've rationalized a lot of their locational presence also. So my sense is they're using capital more effectively now, and they'll probably end up getting a growth in revenue, even if it's at a cost of marginally, at a cost of margins. It won't impact the kind of growth trajectory that they can set for themselves. So definitely, I think it's Jubilant FoodWorks 3.0, if not 2.0, because we've seen them change their strategy even in the past, and successfully so. My sense is, given the festive season onslaught and all, there will be a pickup. It probably offers much better risk reward than it did probably in the last 12 months.
Actually, so the big competitor, not competitor, I mean the entity which is, and now this is of course my reckoning, but which is not done damage but hurt Jubilant is not other pizza companies or burger chains, etc. It's Swiggy and Zomato.
It's Zomato. I get the point that Prashant is making is well taken, because now the pizza has to compete with the rolls and the biryanis
which was not the
and
case.
whatnot.
I mean, think about a time when they were not so everywhere. I mean, these services, and not so, not pretty much all platforms are there now, which was not the case. And the delivery from Jubilant used to be timely, with a 30-minute time guarantee. I mean, it used to be great. Now, of course, they've got to compete with all these other cuisines because of these platforms. But Prakash, stay with us. IndusInd Bank is what I want to come to you with a question for. But the bank, by the way, today launched a digital services app called Indi. The app boasts the features like numberless debit card, line of credit, and a super PIN as well. My colleague Rashna caught up with Mr. Sumant Katpatlia, the Managing Director and CEO of IndusInd Bank, and they spoke about this particular app and a little bit about growth and growth ambitions going forward as well. Remember, IndusInd, of course, just came out with their pre-quarterly update as well. Listen in.
We found that there was a gap in the market, and we believe that the trust of the bank and the features like Uberization or Amazon type features was a need of the hour for the younger generation. We created an app which was differentiated on client experience, which had features which was more personalized to the customer, and a customer could make his own rewards program, its own line of credit, an own savings account, and I think additional security features like OTP, virtual debit card, ATM PIN, virtual ATM, virtual cards. I think those were the type of differentiators which we wanted to create to bring in a holistic experience for a client rather than a product experience for the client.
Sure. So with the launch of this particular app, is there a number or a target that you're looking for in terms of customer engagement and customer base increasing?
So we believe that we should be able to add 10 million customers in 3 years. We believe that it's a journey which we've just started. The soft launch just did give us that comfort that there is a very big need in the market, and clients who've experienced this app felt very good, and we got some raging reviews from our customers.
As an IndusInd Bank user, what would you say that is your favorite feature of the app?
So I think the line of credit and the flexibility of the line of credit is a very, very good feature. I think the payments capability which we have created is an additional feature which we've created, and the whole experience on how you move away on the rewards from your definitive in 1 month you're using a certain award, and in the another month you're creating another burn facility, I think is a very differentiated feature.
Sure. Recently, there was a significant growth reported in terms of net advances, where there was a 21% jump. There was also a jump in deposits. What is the strategy going forward with the quarterly update coming in?
So we've always said that our PC6 ambition continue to be between 18 to 23% growth, and we've always said our liability growth, retail liability growth, will exceed the asset growth, and that's where we are.
Okay, well, that is IndusInd with growth ambitions, etc. We have to take a break, but Prakash Devan is with us, and we'll pose that question on IndusInd to him in a bit from now. Of course, more on markets as well when we come back. The Nifty, the recovery is pretty much there. Although there's not more of it. 90 points lower, 19,440 on the index. Stay with us. We're back. Okay, welcome back. 85 points lower, 19,440 is where we are at. Prakash Devan is still with us. Prakash, there was that chat with the IndusInd Bank MD. Did you like this name? Again, one of those, if you take off HDFC Bank, because, say it's too large, ICICI because it's done very well, Axis, okay, there are fans of it. And then there is IndusInd Bank. Again, a lot of people have liked it for a long time. It's not been a very outstanding performer or anything of that sort. I think even in the rally in large cap private banks, which ended many months ago, this was a rather underperformer. What's your view?
Yeah, I agree. I mean, given the fact that it's just done about 15% in the last 12 months, which doesn't sound very exciting these days. The reason is very clear. This was a company, a bank which was under repair. We've seen how they've kind of gone out of the woods in that sense. And the consolidation that's now kind of underway between this 1,200, 1,450 zones, I think is very clearly evident of the fact that they actually have started getting back to focus on growth, which is what's going to help them re-rate. I mean, these things about digital innovations and new launches, I mean, these are part and parcel of growth. I mean, you can't ignore that. In fact, they are more necessary than sufficient to kind of re-rate the company. What's going to help them is that, if they were to inch up to the 4% NIM mark, which is not very far off from what they did last year, and continue to kind of, maintain the healthy balance between, CASA and the lending side, it's going to be quite a good re-rating candidate for the simple reason the risk reward is far better. I mean, it's available at 2 times book, if I'm not mistaken, which is really not, very expensive. And it, of course, has its presence in terms of markets, the right kind of segments and all of that. So pretty decent balance sheet now, can grow. And I think by and large, you need to understand the private sector banking segment is actually underowned now vis-a-vis the PSU side. I mean, there's so much of money that's come into PSUs in last December. In the last 8-9 months, you've actually seen an overbought situation there. So I think there is merit in looking at private sector banks. You could have a basket. IndusInd definitely features in that, as would an HDFC on the other side, or a small bank like Federal, which is doing its own bit to kind of grow faster. So pretty interesting opportunities, but IndusInd definitely has that salience. It's close to its 52-week highs, but then that's the case with a lot of stocks these days. So you could definitely add that on dips and look at least the next 2 years for the re-rating to happen.
Prakash, thank you very much for joining in. Enjoy the rest of your day. Counting down to the close in the red, but significantly off from the session lows. The Nifty is down 80 points. At one point of time, the Nifty was down nearly 200 points. So from the day's low, there has been a recovery of about 115 points on the Nifty. The Nifty is going to end around 19,450. The Sensex lower by 450 points. The last half an hour recovery was led by strength in many of the IT names and even Reliance Industries, while HDFC Bank continues to be strong. So HDFC Bank was the pillar today, up close to about 1.5%, in fact more than that, after it reported that Q2 pro forma update. IT names like TCS, Infosys, HCL Tech saw buying in the last 1 hour, and even Reliance Industries, if you pull that up, closes in the red, but significantly off from the day's low. Other than that, in terms of the notable movers on the front line, at least in the large caps, you had Adani Enterprises, the top Nifty gainer. Nestle and HUL saw some buying. Losers include all the other banks except HDFC Bank. So Axis Bank, State Bank of India, IndusInd Bank seeing some sharp cuts.
And sharp cuts in mid-caps, and that's not something that we say too often, but look at the way the index is closing out. Almost 1.4% lower on the mid-cap index with a very negative advance decline ratio. So the nerves are still out there in the broader markets. You've got over 2,000 stocks declining and just about 800 advancing. So where was the profit taking most apparent? In a lot of mid-cap financials. Let's look at some names. Manappuram Finance is ending down about 5%. Some of the foreign brokers have written about potential stress, maybe delinquencies, looking at the Q2 update. So there's some fear of that. 5% down on that stock. L&T Finance down about 5%. PNB losing some ground as well. Central Bank of India, a couple of these PSU names down between 3 and 5%, depending on which one you're looking at. Profit taking on Vodafone, down 4% there. Zomato lost about 4% as well. Jio Financial Services down about 3%. Actually, it's mostly financial. I could just go on and on. Union Bank, South India Bank. So plenty of Bank of Baroda, plenty of names on the downside. And then PSUs, BHEL, SAIL. Some of the PSU names also saw a fair amount of profit taking, 3-4% on the way down. That's how it's closed out. So, by the way, on the upside, however, should mention Avenue Supermarts has had a good session today after the Q2 update, 3% up on Avenue. And Nestle stands out. The hopes of a stock split got some green on that one, 3% up on Nestle as well.
Yeah, I mean, interesting list. And on the upside, I mean, maybe we should end with a little bit of green because Suzlon is the top volume traded stock. It's up 5%, closes above 28 rupees now. And the rally in JSW Infra continues. I think there was an upgrade from one of the rating agencies as well, post the IPO. 164 on JSW Infra. I mean, it came to the market just a couple of days back. DMart we mentioned. The other one is Mapma India. It's been a fantastic move. I mean, from 1700 levels 4 or 5 days back, it's at almost 2200. So something certainly coming up there on Mapma India. Ramco Cement is another one which ended about 4% in the green. There's Tata Investment, which ends about 6% higher. Tata Investment also, by the way, is having a very large and nice move. So yeah, I mean, some gainers as well. But of course, the advantage with what is down, and the list is much longer there. 700 stocks are higher and about 1700 stocks were lower in that trade. We'll slip into a quick commercial break here, but stay with us. More news and updates coming up on the other side.